I think 75 is baked in. So if you get a 75, gold is unlikely to go down more. The stock market is unlikely to go down more. 100 would be different. If they have 100, I think gold collapses.
In today's video, Adrian Day, the president of Adrian Day Asset Management and the portfolio manager of the Euro-Pacific Gold Fund, has suggested that Fed policies are likely to negatively impact the price of gold. Day stated that if the Fed raises the interest rate by 100 basis points to control inflation, the value of the precious metal will likely collapse. According to Day, raising the rate by 100 basis points remains a possibility, noting that going back to 50 basis points is not an option. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
The gold price, as I've mentioned to you, has not really reflected inflation expectations. And in fact, historically, the TIPS ETF, going back to the TIPS, have held a very close correlation with gold, 95% if you look back at the past 5 years. But that correlation started to diverge towards the end of 2021. And in particular this year, this is very strange.
Yeah, no, it is. But when you say the gold market right now is not reflecting investor expectations for inflation, I think it is. I mean, the investors are expecting the Fed to succeed.
Even the gold market.
It would appear so. I'm flummoxed. But if you look at investor expectations for inflation, and they think it's going to be 2.6% at the end of next year,
right,
they are believing the Fed's narrative, which means the Fed is going to continue raising interest rates and bring inflation down. And if you believe that narrative, you might ask yourself, why do I need gold? And so I think the gold market is believing the Fed's narrative. And so to answer a question you haven't asked, politicians do that, but they don't say it. They pretend they're answering your question. Yeah. But I'll answer a question you haven't asked, which is, when will gold turn?
I was going to ask that next, but you read my mind. When will gold turn?
Well, obviously a drop in the dollar would help.
Yes.
That's a separate issue. But I think when investors come to appreciate or realize that the Fed will be unable to achieve its target of 2% inflation without a serious recession, when people begin to realize that, that's when you need gold. Scenario I see continues to be for a stagflation. I think we're going to raise interest rates to a point where we have a recession, but we don't bring inflation down.
Do you think we can expect $2,000 an ounce by the end of the year?
By the end of this year?
This year.
No.
You said that with a little bit of hesitation.
No, I think that would be a little bit extreme. And you know what they say about predictions. You either predict a price or a time, but not both.
All right.
But no, $2,000 this year, I think, is a little optimistic. I'd love it, but it's a little optimistic.
All right, so give me one of the two.
But next year, I don't see any reason why we wouldn't see 2,000 next year.
Assuming investors wake up.
Well, your words, but yes, assuming they wake up and we realize that the Fed simply cannot bring inflation down to 2% without an inflation. Then gold is so underloved, so underinvested at the moment, but anything that is favorable to gold will see an outsized response, I think.
I'll close on gold stocks and how you feel about that space right now.
Yeah, well, I think the same thing applies to gold stocks that I just said, only twice as much or 3 times as much for the gold stocks. You look at stocks like, say, Barrick, trading, net cash positive, making money, even at $1,650. Barrick's not alone, I'm just mentioning Barrick, $1,200 cash all-in sustaining costs. They're still making money. But you've got a huge short position in Barrick. No generalist wants gold stocks right now. So when gold starts to move up and sustains that move up, I think you're going to see an outsized return in the gold stocks that are so cheap. Barrick's trading at a 20-year price to free cash flow low. It has never traded lower on a price to free cash flow. Even when gold was $1,000 an ounce, that doesn't make sense.
I'm looking at the latest Fed watch tool, 22 to be exact, and the probability of a 75 basis points hike remains very high at 78%. There is a 0% chance of only a 50% hike. Adrian, what's your view? 75 or 100?
Yeah, I think they're likely to do 75, frankly. That's what Jerome Powell has telegraphed, admittedly before the latest inflation print. I don't think they need to do 100. But one thing we know.
Well, I don't mean to cut you off, but he did actually say that at the last Jackson Hole that the markets could expect an unusually large rate hike. Those were his words. He didn't specify. I don't know if he specified that he would stop at 75.
No, he didn't. But I think the market is expecting 75, and the Fed normally is pretty good at sort of telegraphing or letting you know if it's going to do more. One thing we know for sure, if it's not 75, it's going to be 100. Yeah. It's not going to be 50. So, and that's why obviously, gold has collapsed and everything else.
Right. So 75 basis points. Adrian, we're going to talk about the long-term outlook for Fed policy. But in the intermediate term, I'm wondering why the likelihood of 100 basis points declined over the last 2 days. Maybe the markets just overreacted to CPI data this week?
I suspect that's the case. Okay. The report comes out, they react, and then, of course, the stock market fell a bit, so maybe they think, oh, well, maybe we can't afford 100%, we'll stay with 20.
It's a very dramatic fall. It's the largest single-day drop since 2020.
Yeah, and so you pull back then, saying, oh, well, they're not going to do that and cause more damage in the market. I think 75 is baked in, so if you get a 75... gold is unlikely to go down more. The stock market is unlikely to go down more. And I mean go down more on that news. 100 would be different. If they have 100, I think gold collapses again on that news. One of my big criticisms of the Fed, as you know, I have a lot of criticisms of the Fed, but one of my criticisms of the Fed, particularly under Powell, they say they're data dependent. When you're data dependent, by its nature, you're looking backwards. You're looking at what's already happened. And it might be a week old, it might be a month old, it might be 6 weeks old. And so when you look at the unemployed, what I've suggested, somewhat facetiously, but not completely facetiously, they've got 400 PhDs in economics in the Eccles building. Jerome Powell should get 3 or 4 of them to sit on company conference calls and listen to what Starbucks and Amazon and Facebook and so on and so on and so on are all saying about employment. So many companies are putting a freeze or announcing layoffs. That's future looking. What the Fed is doing is looking backwards. I think that the most critical thing is that by its nature, the economy is strong before it falls into a recession. It doesn't just slide for 10 years downwards, typically.
Okay. Well, how severe or prolonged could this recession be?
I'll tell you what I'm concerned with. We've had interest rates move from basically 0 to 2.25, and we're probably going, let's say we go to 3. And they want to get to 4 by the end of the year. Yeah. So they may do 100, but let's say so that's a huge increase. But, a 3% inflation rate, even a 4% inflation rate, Fed funds rate, is not historically an incredibly high rate. It's not a punishing rate. Right. What I'm most concerned with is the reduction in the balance sheet, which, for the last 3 months, starting in June, they had a timetable to reduce 42.5 billion a month. That's 119 billion in 3 months. They got to 37. So they only did a third of what they targeted. Starting this month in September, they have announced very clearly, and Jerome Powell has never said they're not going to do it, 95 billion a month. If they start pulling out 95 billion a month, in effect, when they reduce the balance sheet, they are withdrawing liquidity from the economy. But in practice, what they're doing is they're having to sell, not just roll over, but they're having to sell treasuries and having to sell mortgage-backed securities, and someone's got to buy those.
Why are they reducing the balance sheet?
Why are they doing it?
Why?
Because the balance sheet is a sort of reflection of liquidity in the economy, and they have pumped too much liquidity into the economy, which is one of the reasons why we have inflation. The higher balance sheet and the lower interest rates is the cause of inflation. Jerome Powell, I listened to him last week at the Cato Institute, and he talked about Putin and lockdowns in China and supply issues. And he said, obviously, we have inflation because you have a reduction in the number of goods available and you have an increase in the demand for those goods, which is, of course, true. Too much money chasing too few goods. That's the definition that's why prices go up. He gave us an example. Look at cars. More people are buying cars. because after COVID, they're afraid to use public transportation. I think that's pathetic. That's nonsense. He didn't once talk about the increase in the money supply. You can't have inflation without an increase in the money supply. And when he was asked directly about the money supply, he said, money does not enter significantly into our discussions, which I find astonishing for the Federal Reserve. You know, Milton Friedman said inflation is always and everywhere a monetary phenomenon. And of course, there's particular factors why certain prices go up and other prices go down. But you can't have an inflation if you don't have an increase in the money supply. No, I mean, seriously, look at the mess. Let's assume that there was a reason that the Fed really genuinely had to increase the balance sheet from 750 billion in 2008, 2009, from 750 billion to, you know, what was it at the end of the year, 1.2 or something. Let's just say there was a real reason they had to do 4 billion. Let's say there was a real reason they had to do that. And let's say there was a genuine reason with COVID, although I question this, with COVID that they had to double the size of a balance sheet from 4 billion to 9 billion, a trillion. Yeah. Let's just say there was a reason. Now, with all of the stimulus that was coming on the fiscal side from the governments, there is a very strong argument, and Mervyn King, the ex-governor of the Bank of England, said this last week as well. So I'm not a crackpot on the fringes here. He said the Federal Reserve and central banks should have done nothing. There was no reason with a pandemic. There was no reason for them to increase the money supply because the fiscal side was taking care of it. Anyway, let's say there was let's say that those things were legitimate. Why didn't they reduce it when the panic, when the crises were over? Number one, and number two, did they honestly think that you can increase the balance sheet from $750 billion to $750 billion to $9 trillion over 12 years without having an impact? They're raising rates, but they're also selling their assets, which means by its nature, those interest rates have to move up.
Exactly.
So someone has to buy them.
So they didn't sell their assets back then, right after the pandemic, because they did not believe at the time inflation was going to be a problem.
Well, that shows you how wrong they were. And they were wrong because they do not believe that money causes inflation.
How far can they go in terms of raising rates?
I think withdrawing money, reducing the balance sheet is more critical than to the economy than raising rates. But how far they can go, that's a good question. You know, higher interest rates are clearly but they are more importantly going to have an effect on the economy. They're going to have an effect on particularly small businesses. And you think of junk bonds, for example. Junk bond yields got down to under 4%. Right. Under 4%. Now, when you start to raise rates, if rates go up by 3%, you don't now get a 6 3/4 junk bond. Right. You get a higher junk bond yield because as rates go up, the gap between treasuries and junk widens. Yes. So a company that borrowed money at 3 3/4%, and remember, junk means by definition that there is a reasonable chance of a default. If the rating agencies don't think there's a likelihood of default, you don't get a junk rating. So these are companies that have some danger of a default anyway. If instead of paying 3 3/4% for their money, they now have to pay 8.5%, 9%, that is going to have a dramatic impact. So we're going to see a lot of smaller businesses, particularly, as I say, people who borrow in the junk market.
Does that mean cutting rates, or does that mean just keeping rates the same?
Good question. I mean, pivot technically, I don't know, but dictionary definition.
What are people talking about?
Yeah. When you talk about a pivot, you mean the Fed's going to do what it did in 2018, 2016, 2005. They're going to raise rates and then they're going to stop and then drop them again back to where we were. I don't think we necessarily have to have a pivot. I was not in the camp. You may remember when we talked last year, all my hard money friends were saying that they thought this would be the shortest tightening cycle on record. I didn't agree with that. And I didn't agree basically because there actually is an inflation to fight. Okay. Back in 2017, 2015, 2005, there wasn't any inflation to fight. So the Fed had nothing to lose. Yeah. But so the question now is, when will they pivot? pivot. I don't think they necessarily have to pivot. My scenario, frankly, would be that the Fed would pause at some point. They'll raise rates to 4. They'll say, we think 4 is a neutral rate, particularly if you do get a decline in the CPI or the PCE, which is their preferred measure. You get a decline for 2 or 3 months in a row. They say, okay, it's working. Let's pause. I think we're more likely to see a pause, but at the same time, we're going to see a continuation of fiscal profligacy from Congress and the administration.
Right.
And so and that leads you into a stagflation. I don't think at this point the Fed is going to stop and immediately turn around. You just mentioned there actually is an inflation now.
Yes.
Whereas there wasn't in those years.
Yes.
And so that means they do actually have something that they need to battle. I don't think there's any chance, I don't think there is any probability that the Federal Reserve will bring inflation down to 2% in the next 12 or 18 months without causing a serious recession. And I think they will stop ahead of a serious recession.
You don't think they're going to stomach a serious recession?
I don't think Powell has the stomach compared with Volcker. Another factor, if you look at it, okay, how come it happened in 1979, 1980, and we don't think it'll happen now? Well, number one, interest rates relative to inflation were much higher back in 1979. So not to discount Volcker's great effort in stopping inflation, he had a easier time of it than Powell does. Powell started with inflation rates at 0 when the CPI was at 9. That's a huge gap. And we didn't have that in 1979, number one. Number two, the debt to GDP in 1979 was 31, 32% or something, which is reasonable. Now it's 4 times that amount. That means higher interest rates have a much more significant impact on the economy than they did back then. The other thing is just for personalities, and that's a subjective thing. You know, Volcker chewing his cigar, had the determination and didn't care what people said, frankly. I think Powell is very concerned about his legacy. But more important than Powell, I think, more important than Powell versus Volcker is Biden versus Reagan. Reagan was the new president in 1980, and Reagan accepted that the cost of bringing inflation down was a serious recession. You can argue, well, he had it at the beginning of his first term, and he could argue that it wasn't his fault, so let's get it out of the way. Fine. But the plain fact is, Reagan accepted that there would be a recession and supported Volcker. I asked a question rhetorically, I have an answer, but I asked the question, when the unemployment rate starts going up, when people start complaining to their congressman about their 401ks and savings collapsing, when people get their credit cards canceled, et cetera, when we're in a serious recession, will President Biden will Powell have President Biden's support to keep on going?